Now, one stock that we are eyeing this morning quite closely is Novo Nordisk in the healthcare space. The company announcing plans to cut 9,000 jobs as part of a restructuring aimed at saving the pharma giant roughly 8 billion Danish crowns a year. Most of the job losses will be in Denmark. The restructuring comes as Novo's weight loss drug Wegovy loses market share amid slowing sales, particularly in the United States. In terms of investor reaction here, clearly this is a company, a stock that has come under a major pressure over the last year as the company has been losing market share primarily to compounding pharmacies, so generic drugs in the United States, but also Eli Lilly, their main competitor, who's out with arguably more effective versions of these weight loss drugs.
This stock cannot catch a break. It feels like it's on a continual drawdown. And actually, if we go back to just last year, June 2024, it was sitting at a record high, but it now feels like the company is having a lot of negative sentiment. Analysts continue to cut their price target. And actually, after the news that we're about to run through today, this company was trading after hours down nearly 8%. Now, we can already see in the pre-market today, it has recovered a lot of that drop, but we want to understand two things today. For a company that has been battered down nearly 60% in the last year, year to date down around 37%, and trading not too far off their 52-week low, is this one to even continue to consider? What is the bad news and how will it affect them in the longer term? Now, over the last 10 years, it hasn't performed that great after the downward trend that we just mentioned started from June last year. It's up not even 100%, and the all-time high now feels like such a long time ago. We also only get one buy rating, that is from Seeking Alpha, with now Wall Street calling this a hold, something that Quant also agree with. You'd probably also be a very disappointed shareholder, at least year to date, when many companies in the S&P are up strong, we're talking double digit, but overall the healthcare sector hasn't performed that great. Even one of their competitors, Eli Lilly, is also down, but we're only talking 3%. That is a massive, massive contrast. What's also interesting, because of the issues that Novo Nordisk has faced, the country itself, Denmark, has had to cut their overall growth forecast, and we're talking down to 1.4% from 3%, and they've actually cited weaker prospects for Novo Nordisk, which has led them to this decision, as well as tariffs on Danish goods overall from those exported to the US. And we want to kick off first on a valuation perspective before getting into some of the news that overhangs the company. Forward P currently sits below 14 when the average is at 30.4. Now, straight away, regular viewers know this is what we would classify as a severe undervaluation signal, 14 below the average. Although we don't look at this in pure isolation, but when you couple this with a yield above 3%, 3.2 versus 1.4, that again in itself is all pointing to something that investors should sit up and take some serious note of. And given the disparity of where the yield sits today versus the 5-year average, we just want to highlight the dividend safety score looking good, 90, very safe. And it's also one that increases their dividend at a very rapid rate. We're talking 20% over the last year. It's also worth flagging when we look at the blue tunnel, and for those that are new, within the parameters here is in fact the intrinsic or the fair value, we get another severe undervaluation signal. Look at the disparity of the share price today versus even the bottom end of the blue tunnel, something that's only increased from December 2024. In fact, share price has been decreasing while the intrinsic value has been increasing even marginally. This disparity is what we would say gives rise to a very strong opportunity. And in fact, when we zoom out to the last 5 years, it really paints a picture that pretty much from 2020 to the end of 2024, Novo Nordisk was classified as a premium stock, one that traded well above its intrinsic value, something now that has changed. Sentiment from investors has flipped 180 degrees. We're now seeing massive opportunities, something that we will discuss as well in our valuation. And in fact, just zooming out even further over the last 10 years, you'd have to go to around 2018, 2019 to see the previous time where this one was trading severely undervalued. And it's not just on these metrics where we see undervaluation. You want to look EV to EBIT is trading trading below 10. That is a decade low, something that also surfaces when we look at a forward P going back not just 5 years as we highlighted, but also extending that to the last decade. These are signals that investors should at least take note of. Doesn't mean you need to buy, but something that should make us want to dive a bit deeper. And the other valuation metric that we haven't covered, whilst we do notice B- overall, is the PEG. That is the price to earnings growth, so it incorporates whether or not a company is growing very rapidly and putting that into perspective. We get 2.05. Now, over the last 5 years, it's been 2.24, meaning it's trading at around a 9% discount, but actually the sector overall trades lower, so you're paying a 13.2% premium. What we would say, generally, we want to see below 1. That is a massive alert signal that there could be some serious undervaluation. Below 2 is what would also grab our attention, so it's sitting pretty much around that threshold. But the other thing we want to quickly contrast it to when we're looking at valuation, Eli Lilly. Now we are getting another undervaluation signal, 28 on the forward P versus 38 overall. This highlights two things. Yes, undervaluation signal, but actually it trades at a higher valuation than Novo Nordisk, something that similarly when we do look at the blue tunnel, we do get disparity. So actually on both accounts, Eli Lilly and Novo Nordisk, two large pharma companies, we're getting undervaluation. Likewise, this is one for a very long time was trading at a premium and quite a significant one. Only now are we seeing this in an undervalued space. And yes, whilst it does get an F on the valuation, we're really highlighting this because in contrast to Novo Nordisk at a PEG of 2.05, Eli Lilly for its growth actually looks like a better opportunity. 0.9, which is below both sector and significantly below their 5-year average. This is a 57% discount. Now, we're not going to go into this company in much more detail today, but we just want to highlight, whilst Novo Nordisk does look very attractive, Eli Lilly, if you incorporate the growth this company has, it could perhaps be another one for consideration. Now, Novo Nordisk seems to be getting a lot of headlines which put it in a negative light. We have here the CEO was pushed out pretty much due to the issues they've been facing. Whether or not we're going to see a decline is something to consider, as they were holding quite a significant market share. But ultimately, competition is something that does overhang on this company, which will affect its growth moving forwards. And now they've had to cut 9,000 jobs. Now, they put this down to a few things. Firstly, they say to become more agile. Secondly, they talk about a more competitive and consumer-focused market. This in totality has unfortunately led to a very large job loss, of which they say around 5,000 of those will be in Denmark and will actually save them around $1.3 billion. That is every single year by the end of next year. And that's not all. There is also a big profit warning that we are going to touch upon. So typically what we see with companies when they talk about job cuts, it actually is positive sentiment on the share price. Lower costs ultimately mean a larger bottom line as long as it is done in the most effective way. And we actually notice here one perspective actually talks about competition being very aggressive from rivals that doesn't just include Eli Lilly. We actually have here what they've noted as the copycat wars. Now, Ozempic was actually launched in 2017 where they also released Wegovy. In fact, both of these in combination really led to the drive that we saw earlier on in their share price reaching all-time highs. However, now, as we've highlighted, their drawdown, even at some point this year, has been larger than 50%. And not only are we seeing competition from Eli Lilly's Mounjaro, but we have some notes here that it appears to be more effective at treating obesity, something you really need to consider with pharma companies. You will see a lot of volatility whenever we see drug trials come out, where, for instance, one drug has been a lot more superior than another. But as we said, not just Eli Lilly, there is also the counterfeit weight loss drugs, which ultimately will harm the growth of the company. It will harm their bottom line perspective, and that's also something we've seen in relation to Ozempic. Now, if we look at both of them, they've been growing at a very rapid rate. Ozempic, we're talking from 2019, 44% year on year. Wegovy from 2021 at a triple-digit rate. But the one thing to note here, Ozempic has been slowing down in the last 2 quarters. Definitely something we would say take a note of, and that has ultimately affected their outlook. And we're also hearing that they've started to cut their pipeline. Now, you could look at this in 2 ways. One, in a positive way, because what they're essentially saying is anything that isn't related to their core obesity and diabetes medicine, meaning they're going to put all of their attention into something that they are the market leader or you may look at it from the flip side and think actually it doesn't leave them room to grow their income streams. At the moment, it is heavily reliant on obesity and diabetes, although we heard not that long ago they did get approval from the FDA in relation to liver disease. Now, one thing that we haven't touched upon that we should now discuss, although we can see it is relating to some one-off cuts, they're lowering their operating growth forecast. Now, this is something what they say in the region to 4 to 10%, and unfortunately this isn't the first time we've seen them cut their outlook. If we look at July, so just a few months ago, they actually say here they cut their forecast again, so we're talking not for the second time but actually the third time in 2025. Novo Nordisk have cut their outlook. Now, in terms of sales, it does remain to be what they mentioned on the 6th of August, 8 to 14%, which we note was a drop from the previous expectation, 13 to 21, but the one that is affected today is the operating growth. If we look at May, it was 16 to 24, then got dropped last month to 10 to 16. Now they're saying in the region of 4 to 10%. So not good news. However, we can look at the perspective of these one-off cuts, which they did say they anticipate to save a significant amount. We're talking in the billions this year as well as 2026. The other thing to factor in when we do get to our valuation is the free cash flow. That was a large drop from the previous expectation, which will affect our discounted cash flow model. But overall, if we do look at their historical performance, numbers are very strong. First 6 months of this year, we're talking in fact revenue is up around 16%. We've got operating up 25%, their profit before tax up 24%, bottom line and in fact earnings per share in the 22 to 23% region. So definitely one for now that isn't showing signs of a large slowdown. And we also have some good news not that long ago. If you remember, Donald Trump was talking about some very large tariffs on pharma, anywhere in the region of 100 to 250%. It does look like, at least for now, he has backed down. And they did release their earnings not that long ago. We're talking on the 6th of August. Now, we did get some marginal misses, although if you look at different analysts, different forecasts, we can see that they believe EPS was in line. But overall, if we look year on year, earnings per share was up 39%, revenue was up 20%. However, earnings per share was down around 7% from the previous quarter. And they do expect growth to close out 2025, although we're talking in the mid to upper single digit, with a track record over the last 4, based on this analyst, 100% track record, either a marginal beat or in line. But one of the things that has affected this company is their growth. Now, we're not talking revenue, as that last year was up 21%, expected around 17% this year, which yes, it is above the sector median, but actually we are noticing it's also a little bit higher than their 5-year average, so they're growing at a slightly quicker rate. The kicker here is though earnings per share, as we just heard, is expected to be lowered. And in fact, if we're looking out to the next 3 to 5 years, EPS growth 7%, below the sector at 10.3, quite some way below their own historical of 14.7. But this is a pharma company, so we do expect it to be very profitable. We're talking A+, 84% gross margin, well above the sector at 60, pretty much in line with their 5-year average. Bottom line, 36%, well above the sector, which actually comes in at 0, meaning they're making no money, and nice to see a bit of efficiency on their own 5-year average. They're also generating a lot of cash from operations, just under 20 billion, whilst the sector burns through cash, negative 11 million, and also an improvement on their own 5-year at 12.2, quite a significant jump at that. And as always, we like to flag what the institutions are doing. They have 12% ownership, selling 6 billion, we're talking in just the last 12 months. Same time frame, they've bought a little bit more, but what's very important to see, in the most recent quarter, they've bought nearly twice as much as they have sold. They're definitely net buyers. Maybe we're starting to see them turn bullish as the share price has been getting hammered. And as we like to look at these super investors, 5 of them in fact hold this in their portfolio. We got one that reduced their position quite significantly, another that made it a new position overall, and another one that added only marginally. Nothing really to draw out, but always good to see just in case there are any large movements. And as we always say, if you're investing in individual companies, you want to outperform an ETF. Otherwise, what's the point in buying? What's the point in having that stress to see if it can outperform in the longer term? In the last year, clearly they've massively underperformed, negative 58%, S&P, QQQ a lot better. Over the last 5 years, the result is the same, although the gap has started to narrow. But over the last 10 years, very important to see, they have massively underperformed. Question here is though, if you are buying today, do you believe they can outperform in the longer term? As we said, otherwise you could consider an ETF like VO that tracks the S&P, or in fact the QQQ, which has over the longer term outperformed. And the other thing that we like to do is just see whether the issues they're facing is essentially a sector-wide point. But actually in the last year, we notice they've been down 58%, a lot more than any of their competitors. That also includes the likes of Eli Lilly, that's down 17%. But actually over the last 5 years, unless you're invested in Eli Lilly, pretty much the sector hasn't been the best performing. We're talking even Pfizer in this period down 9%. Over the last 10 years, that conclusion still pretty much remains. Unless you're invested in AstraZeneca or pretty much Eli Lilly, you would have massively underperformed the S&P. But if we go back to this company, what is the quality like? What are some of the metrics we want to point out? Firstly, free cash flow per share. As always, we want to invest in companies where we do notice it's consistently increasing. Now, we do get an increase nearly 3 times in the last 10 years. Not consistent, maybe not something you expect from the pharma industry, but worth flagging, anticipated to drop into the next 12 years to around $14. Sales growth as well, not as consistent as maybe we would like to see, although we do notice over the last 4 years, double-digit growth. It is still expected to continue into 2025, but at a slightly slower rate. And then we notice the shares outstanding. Now remember, they do pay a dividend if you're buying today over 3%, but we also want to see, do companies return excess cash through share buybacks, something Novo Nordisk continue to do, maybe at a faster rate in the next few years if management believe the share price is severely undervalued. And the other one of our favorites, is the ROIC. Now we like 10% at a bare minimum. Give us faith, management can effectively allocate their capital. Now, even though it slowed down, 44%, 42 on a trailing 12 month is very strong, something we love to note for this company, alongside their margins operating not only above the minimum 12, but we get to see efficiencies, 43 10 years ago, now sitting at 48, and free cash flow margin, whilst inconsistent, well above the minimum and still looking very healthy at 20%. Now, the last metric that we will speak about is the net debt to EBITDA. Tells us the number of years it would take Novo Nordisk to pay off all of their debt net of cash on hand. Below 3 is what we want to see, and also correlates to balance sheet strength, dividend safety. 0.54, not bad on a trailing 12 month, expected to be there or thereabouts in the next year. So overall, we would say balance sheet looks healthy, and we can take a very quick look. But before we jump into the balance sheet, we want to highlight one thing on the income statement. Yes, we love companies that grow their top line. Novo Nordisk, 16 billion 10 years ago, nearly tripled in 2024 to 40 billion. But are we seeing consistency reflected in the bottom line net income? Revenue has been increasing. Has the net income followed suit? And the large part is, yes, maybe not massively consistent, but nonetheless nearly tripled from 5 billion, now sitting at 14. And the other one is that quick health check, total cash versus total debt. Now we do notice cash pretty inconsistent, which is fine, no issues. 3 billion 10 years ago, now pretty much sitting at the same amount. But we want to understand, how does that compare to the total debt? Because numerically or even directionally, these numbers tell us absolutely nothing. That is why we do that comparison. Actually, whilst cash has stayed flat, total debt has increased. 156 million 10 years ago, now sitting at 16 billion. Definitely something we would say to keep an eye on. Just look at that jump from 2023 to 2024 is continuing to climb. So we would say for now, keep an eye on. Balance sheet does look to be healthy, but something we can review on a periodic basis. And before we jump into the valuation, we want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox completely for free, covering severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of September, lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that you can grab a spreadsheet of 29 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now our intrinsic value today has two different figures. The first model, $46, is where we see this company. The second model we get to $72. Now we will run through each one as they are based on different scenarios. So kicking off with the first one at 46, which is in fact on both accounts derived from the DCF, we have the free cash flow year on year, average growth at 10%, and we've used 2025 as we highlighted earlier on their revised outlook for free cash flow for this year, and you'll notice we have a low, medium and high. As always, numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, Novo Nordisk or any others. First thing also to flag, we've lowered our expectations 10, 12, 14. Previously this sat at 12, 14, 16, given some of the competition issues they are facing in the short to medium term. Now 12% with the discount rate gives us the present value of future free cash flow terminal price, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, getting to $46, indicating 15% downside. Now for transparency, we will highlight for those that believe these numbers are too high, at 10% we're talking $40, that's downside of 26, and for those that believe we're being way too conservative, at 14%, $52, around 4% downside. Now typically we do like to take through the middle rate at 12%, which does get us to $46, but what this highlights, if you believe in the longer term they will be affected and we should start in fact from what they have revised, then baked into the numbers today, if you're buying at $54, is 14.4% growth to the future free cash flow. So already if you believe that's too high, you would see NVO as overpriced. What does this mean? Well, typically we like to use a 10% margin of safety to kick things off. This flags if you're buying today under this scenario, you are paying an 18% premium. For those that believe we're being way too conservative at 14%, you will still be paying a premium, but much lower at 3%. Wall Street themselves see this at $68 into next year, translating to 26% upside. So whilst we didn't get a buy rating from them at the beginning of the episode, still one they see for consideration. Now if you do want this and actually you want to stick to the middle rate of 12% and you want to know the different rates in terms of margin of safety, well at 10% it becomes a buy at $41, at 20% it becomes a buy at $37, and at 25 the three different rates we like to use, $34. Scenario 1 though, $46 intrinsic value, 18% premium. We then flip into the second scenario, which gives us the larger intrinsic price. Now the only difference here is we've used their initial future free cash flow for those that believe these issues will be short-lived and they will get back to the strength we have seen from the past. Also worth flagging, based on this, on a reverse DCF, 7.5% is baked into the numbers today, and with 12% we are talking 33% upside. Also gives rise to a 25% margin of safety, which could be one for serious consideration. Wall Street price target $68. Now for those that want to be a bit more conservative at 10%, you still will be getting a margin of safety, naturally at a lower rate, we're talking 15%. And if you wanted this more conservative rate but at a higher MOS, we're talking a buy around $48. Let us know your thoughts overall though on Novo Nordisk. Is this one to buy, maybe hold or maybe avoid? Whether or not you're more positive based on the news of cutting jobs, or this is one that has seriously got you head scratching. Don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.